Hello traders, Gary Wagner here just about noon in Honolulu, 6 o'clock in New York. It is Friday. Happy Aloha Friday as we say on the islands, October the 20th, 2017, and this is the Daily Report for Gold and Silver, our weekend review, and what a week we have seen. All of the upside potential and upside moves we saw last week were pretty much taken away as we saw this week result in about 90% of last week's gain eroded. The market severely under pressure over the last couple of trading days, except for yesterday in which we saw an upside bounce. Today, for example, gold down $8.20, closing at $1281.80. $12.80, a critical number, which we'll talk about during the show. Silver down 21 cents at $17.04. And this was really a dollar-based move, with the dollar accounting for about 90% of the downside move today. Dollar up almost a full 0.5% at 93.57. The market giveth and the market taketh away, or in the case of today's action, the dollar gives and the dollar takes away. Today, a strong U.S. dollar was 90% responsible for the $8 drawdown exhibited in gold, with December futures closing at $12.82, and that is a drop of about 0.6%. When we look at our daily candlestick chart, we see that today the market actually opened above yesterday's close, which was a sizable upside spike, and closed below the real body of yesterday's trading activity, resulting in an engulfing bearish pattern. Now, of course, the primary characteristics of the engulfing bearish is the fact that you have one candlestick's real body totally engulfing the prior candlestick. However, there is another very important criteria. And traders, that is where the pattern occurs. In other words, if the market has been in a defined uptrend, as we see right here, an engulfing bearish found in this area would be a correct pattern identification. However, when you see the market in a decline, such as the recent activity we've seen here, and then you get this formation, it has been called a last engulfing bearish, and typically will represent an exhaustion signal and a potential bottom in the market. Now, with all that has occurred this week, we'll have to wait and see how the market reacts next week to see if that holds any kind of truth. Because the fact of the matter is, when we consider the most recent rally that began on the 6th and ended on the 16th of this month, so far, we have seen the market decline or give back 61% of that move. Now, as you know, we have been flat with no active trades in this market since we pulled profits, very small profits, but profits nonetheless, earlier this week. The key to this week's activity and the most recent activity was the fact that as this rally came and broke above 1300, it stalled directly at 1309. This particular candle would be called a hangman, and from there we have seen a market decline until we had a series of lows that came in at this 61% retracement. Although yesterday we had the potential for some sort of bottom activity, and in fact I was hoping for follow through because that would have signaled a buy. We got the exact opposite, in which the market opened higher and closed lower. Nonetheless, at the same time, what needs to be focused upon are these recent lows and the fact that there is very good support in gold at $12.80. And as far as I'm concerned, that is a critical area that the market needs to hold if we can maintain our current bullish model. And traders, what I mean by a bullish model is that it is in no way a short-term bullish model. Rather, this is a very, very long-term bullish model that really begins at the end of 2015, beginning of 2016, when prices in gold finished a multi-year decline from $1,900 per ounce and finally traded to a low of $1,040. Because at that point, for the first time since that multi-year decline, we actually had a low come in, and then the high that came in was above the prior high. So we got a higher high. Market corrected, and then the low that was achieved, of course, was above the prior low. So we had a series of higher highs and higher lows. Then we had, of course, this market has come up, and this right now is where we're looking at. We do not have a higher high, but we do have a series of higher lows. So what I mean by a long-term bullish model is we inevitably, to maintain this model, we need to see the price point of 1380 taken out and gold prices trading to a higher high than that. Now, of course, based upon recent activity, we have seen this market under dramatic pressure, and these are the recent lows at 1260. So although on a short-term basis we have had a series of highs and lows, higher high, higher low, equal high, lower low here, and then a higher high, and now a higher low, we still need to see the market move to new highs to maintain this model. So traders, any real optimism that was created over last week's trading and spike to the upside, in which we saw gold once again break above 1300, that certainly was taken away this week as the market tracked and closed dramatically lower on the week. We are obviously going into the weekend flat with no active trades, and as I said, we want to see if gold can hold 1280, a very, very critical price support area. Traders, it has been the optimism around a potential tax cut that has truly created the risk-on environment that has been so prevalent over the last 6 weeks, with the Dow, the S&P, and the NASDAQ running to all-time record highs. Whether or not this tax cut is enabled and laws are passed to implement it is yet another question, because late breaking news that came out talked about a massive budget deficit that is currently within our administration. As such, and the fact that we have not really dealt with any kind of entitlement cuts, questions where the money is going to come from this tax cut. But that is the topic for yet another day. This has been Gary Wagner, wishing you as always good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.